Most people think they need thousands of dollars before they can start investing. The actual number? $1. In the next few minutes, I'll show you why starting with a single dollar today is worth more than waiting to have $1,000 tomorrow. The last thing I'll share is a story about a janitor from Vermont who died with $8 million, and it'll change how you think about money forever. Grab a cup of water, settle in, and let's get into it. Here's something worth knowing. Every year you're in your 20s and not investing, the math quietly forgives you. It bends in your favor, but somewhere around your mid-30s, that forgiveness disappears. The curve steepens. The cost of each lost year doubles, then doubles again. That clock started the day you turned 18. It doesn't pause while you're figuring things out. So let's make sure you're not wasting another day. The barriers that used to keep regular people out of the stock market, gone. Fidelity lets you open a brokerage account with $0. Their index funds have zero minimums. Robinhood lets you buy fractional shares of any stock for a single dollar. Acorns rounds up your spare change from everyday purchases and invests it automatically. Over 10 million people are doing exactly that right now. Think about what this means. A single share of Amazon trades around $180. Berkshire Hathaway Class A, over $600,000 per share. But with fractional shares, you can own a sliver of either one for the price of a gas station coffee. This shift happened fast. Fractional shares only went mainstream around 2019 and 2020 when Schwab, Fidelity, and Robinhood all rolled them out within months of each other. Before that, if you couldn't afford a full share, you were locked out. Now the door is wide open. So what do you actually buy? You don't need to pick stocks. You don't need to study earnings reports. You buy an index fund. John Bogle launched the first one available to everyday investors on December 31st, 1975 through Vanguard. Wall Street laughed at him. Rivals called it Bogle's folly. That fund now manages over $800 billion in assets. The S&P Dow Jones SPIVA report from 2023 found that over a 20-year period, roughly 95% of actively managed large-cap funds underperformed the S&P 500 index. 95%. The professionals lost to the boring index fund. Bogle said it best. Don't look for the needle in the haystack. Just buy the haystack. Here's what you do. Open a free account today. Buy $5 of a total market index fund. You click a button. That's it. A few weeks later, you open the app. Your account is up a couple of dollars. You didn't trade anything. You didn't analyze a single chart. Money grew while you were sleeping. It almost feels like cheating. But that's step one done. You're an investor now. The hardest part is already behind you. Now here's where things get interesting. If your job offers a 401k with an employer match, you're sitting on what might be the single best deal in all of finance, and a shocking number of people walk right past it. According to Vanguard's 2023 How America Saves report, the average employer match is about 4.7% of your salary. If you earn $50,000 a year, that's roughly $2,350 your employer hands you, free, just for contributing enough to your retirement account. That's not a market return. That's not a maybe. That's an instant 50 to 100% return before the stock market does a single thing. And yet 22% of 401k participants don't contribute enough to capture the full match. Imagine logging into your account and seeing $2,300 sitting there, unclaimed, with your name on it. That's what's happening. Every single paycheck. Let's make that concrete. $2,350 a year, unclaimed, invested at 7% over a 30-year career. That's approximately $235,000 in lost wealth. $250,000 gone because someone didn't change a number on their HR portal. Maybe you're thinking, what if the market drops right after I start? Fair question. If you'd invested $10,000 on January 1st, 2000, right before the dot-com crash, then rode straight into the 2008 financial crisis, by 2024, that money would be worth roughly $37,000 to $40,000. Kept it in a savings account instead. About $14,000. Time heals market wounds. Cash does not. If you do nothing else after watching this, do one thing. Go to your benefits portal. Increase your contribution to at least the match threshold. It's the closest thing to free money you'll ever find. If this is clicking for you, hit subscribe. I drop videos like this every week. And the best part? It's coming up right now. Okay. Remember that janitor I mentioned at the beginning? His name was Ronald Reed. He lived in Brattleboro, Vermont. He worked as a gas station attendant, then a janitor for most of his life. He drove a used Toyota Yaris, cut his own firewood, wore flannel shirts from the thrift store. Nobody who knew him would have called him wealthy. When Ronald Reed died in June of 2014 at age 92, his estate was valued at $8 million. $8 million from a janitor. His family was stunned. His community was stunned. His attorney, Lori Rowell told reporters. He was a hard worker, but nobody would have expected this. The Wall Street Journal broke the story in February 2015 and it went viral. What was his secret? He started investing small amounts in blue chip dividend stocks early. Companies like Johnson & Johnson, Procter & Gamble, CVS. He reinvested the dividends and he never sold. Not during crashes, not during booms, not ever. He just let time do what time does. The math backs him up completely. Invest $5,000 at age 25 and never add another penny. At 7% average annual return, you'll have roughly $75,000 by 65. Wait until 35 to invest that same 5,000, about 38,000. Same money. 10 years difference, a gap of nearly $37,000 created by doing absolutely nothing. Or look at it this way. $50 a month starting at age 22 grows to about $131,000 by 65. Start at 32 instead, $64,000. That 10-year head start is worth $67,000 on just $50 a month. Remember that forgiving curve from the start. Here's where it stops forgiving. A Bankruptcy survey from 2023 found that 26% of Americans cited not having enough money as their number one reason for not investing. Bigger than fear. Bigger than lack of knowledge. The median amount people said they needed before they'd start, $5,000. But waiting to save up that $5,000 is the most expensive decision they'll ever make. The amount you start with barely matters. The date you start matters enormously. The market doesn't care how much you bring. It cares how long you stay. Charlie Munger, Warren Buffett's partner for over 6 decades, put it perfectly. The first rule of compounding is never interrupted unnecessarily. Ronald Reed didn't have a secret strategy. No insider knowledge. No finance degree. He had time, patience, and a decision he made decades before anyone noticed. So there it is. You can start with $1 today. The barriers are gone. Free money is likely sitting in your employer's 401k match, unclaimed. And the most powerful force in investing isn't money. It's time. The janitor who drove a used car and cut his own firewood proved that with $8 million. Open the account, buy the index fund, set it to automatic, then forget about it and let the math work. Every single day you wait is a day compounding can't get back. If this video helped you see investing differently, share it with someone who's been putting this off. Subscribe. You don't want to miss what's coming next week. Now go start, even if it's just $1.